Welcome to this week's episode of Ask Amy. Joining me today is Danny Ratliff. He is a senior financial advisor with RIA Advisors. Thanks for coming in.
Hey, thanks for having me.
Yeah, so the reason that we wanted to talk to you today, we're well into 2023. We continue to hear that we may be going into a recession. The economy is doing poorly. We keep hearing all of these things, but I don't know that people are paying that much attention until we had a couple banks fail.
Yeah, well, it's interesting. I think the banks certainly brought light to this, but the bigger thing is people are looking at opening up their 401k statements, they're opening up their investments and seeing that everything went down. The only place that you could hide last year was cash.
Yeah.
Bonds have historically been a safe haven. They didn't do as well, but the banks are a big issue at the moment. And I think this is something that many people are concerned with. Like you said, now people are kind of opening their eyes saying, whoa, how bad can this get?
Right.
And that's the $1 million question.
And I think so the banks may be just what caught people's attention. Mm-hmm. But then I learned a little bit about when these banks failed, Silicon Valley first and then Signature Bank. But I didn't realize, we hear FDIC and that, consumers, I always thought shouldn't be concerned because all your money's insured. Yeah. But then it's like, oh, wait, there's a limit. Not all of your money is insured?
No, not all of your money. So there's a limit up to $250,000. I think this is really important. So, not everybody has $250,000 sitting around in a checking account or savings account. And for that matter, you probably shouldn't. You should probably find a better alternative, someplace that you can make a little interest on it.
Uh-huh.
But if you did and you had money at Silicon Valley Bank or Signature for that matter, you could have been exposed, or you were exposed if you had more than that, and the accounts were not structured properly. So it's really important. Make sure that you're under the limits of 250, or if you have an account with your spouse, or depending on how the accounts are set up, you can have more FDIC insurance. It's based on registrations. FDIC has a really cool calculator. Uh-huh. It's called EIDE. Uh-huh. So it's EIDE calculator. And so you could go to online, Google FDIC calculator, and you can put in the bank, put in how the accounts are registered, and it'll actually tell you if you're covered.
Oh.
But, with us, we go out and buy CDs for clients from time to time, mm-hmm. and we always want to make sure we're under those limits. That's really important.
Okay, and that is really interesting because this would count whether your money's insured, whether it's in a money market or a CD or savings or a checking account.
That's right.
And where I thought, you're right. Not most people don't just have $250,000 sitting in an account at a bank.
Correct.
But I was reminded of people who may be retired and they got their pension and however they took it, and they might just have it there as they're deciding what to do.
Yeah. I think there's a lot of people who got caught off guard, and you hear these horror stories, and it's unfortunate. Now, a lot of times, the FDIC doesn't necessarily take it over. They broker a deal. Like in 2008, Washington Mutual was the biggest bank that went into conservatorship or receivership, and JP Morgan picked them up. Mm-hmm. And so you also need to think about what it looks like from the investment perspective. What happens to clients in those instances. Uh-huh. And so if you're invested in these companies, that's where you're in trouble too. So you could have had stock in some of these companies, and that's where, if they go bankrupt or they go under, you're stuck and you have bigger losses in that aspect. Oh. But if you had investments with these firms, most of the time those are all registered in your name. And so what will typically happen is that the name on the statement changes. That's it. Okay. So it's not as big of a deal in that aspect, but you do need to be concerned. You need to check and make sure you understand what type of coverage you have, depending on banking and investments, and just understand the risk that you're potentially taking.
Right, and so the bank should also be able to help. Like if I go to that FDIC calculator,
they should.
Yeah, should be able to say, okay, you could vary it up. Even if all of your money's at one institution, if it's in different types of accounts?
You can, yep. So depending on the registration, that's also, it impacts as far as what is all covered with that. So you could actually have, over $1 million, depending on beneficiaries, depending on registrations. Mm-hmm. Do you own this individually? Do you have it with a partner or spouse? All of these things can be taken into consideration. Now, the banks aren't always really well trained on it.
Yeah.
So I always encourage everybody, go online, take a look, write down exactly how your accounts are structured, print out your statements, pull that calculator up, and that'll really give you a really good understanding and hopefully give you some peace of mind. Okay.
And as far as my concerns that my bank might go under, that's the extent of sort of the checks that I need to do?
Yeah, I think, those are always concerns. Smaller banks are typically going to be more prone to something like this versus the really big banks. The problem is, you're paying for safety, so you're not really getting paid much on interest. But I would always be concerned. I'd always want to remain under those limits when necessary. That way you're just not exposing yourself to potential losses.
Right.
Because you never know. I mean, there's been some Washington Mutual. Who would have thought that was going to happen in 2006 and 7? Same thing for Wachovia. I mean, think about all the branches that they had. Great name recognition, very well known. And they just had some bad business practices that were exposed, and people paid for it.
Right, and we've heard in the news. So when these bank failures happened, at least one report said that it caused a lot of consumers to go out and withdraw a lot of money, to make a lot of withdrawals, and then that exacerbates the problem.
Yeah, it does. So Silicon Valley Bank. In fact, just yesterday we found out how much people went out and ran to go, basically a run on the bank, which you don't really hear or see of these days. And so people are pulling out in just droves, and that becomes a problem because it makes the problem even worse. And it multiplies it very quickly because you have to remember what banks do. Banks are taking our money in, and then they're lending that money out. But depending on what type of debt that they expose themselves to, what their type of investments and how they're hedging, that's where there can become additional problems. So banks as a whole have been healthier in a lot of ways. But last year, we saw the worst year in bonds since 1788.
Oh,
so think about that. We're talking about centuries, not decades. We're talking about a very long period of time. And so with the Fed raising rates as quick as they did, if they were holding any longer term bonds, those bonds went down in value, which therefore it exposes them to additional risk. And so that's where a lot of the problems came from.
Got it. And that's what I was going to ask you is sort of these bank failures. There have been 2. What does that say? Or is that sort of a precursor, or does it tell us anything about the chances that we are going to go into a recession?
Well, it could be the canary in the coal mine, so to speak, where it's saying, hey, there are bigger problems out there. I think we are beginning to see that. Higher interest rates we knew was going to expose companies that were in trouble. And so there's an old saying that when the tide goes out, you see who's swimming naked. And so when interest rates go up, it impacts everybody. It starts with the consumer.
Right.
So, your household cash flow begins to diminish, right? Where you have inflation. Now, if you have debt, you're paying more for it, credit card debt, revolving debt. You want to go get an auto loan or refinance the house, you can't do it. Or you can, but it's going to be stricter guidelines and it's going to cost you a lot more because the interest is much higher. So that's why we're seeing, like, even in the housing market, inventories declined because people are less inclined to move.
Right.
Because you're not going to, if you go out, even if you downsized right now, paid less for your home, your mortgage payment would likely be very similar because rates are that much higher.
Right. I mean, 7% compared to 2.5%.
That's right. I mean, I talk to people all the time, 2.75, 3%. I mean, that looks really, really nice right about now.
Yeah, absolutely. So that's really what I want to talk to you about when we come back is sort of the economy that we're in right now, higher interest rates, and how all of those things affect families day to day, and sort of how we can steel ourselves or brace or protect the money that we have right now and keep more from going out the door.
Great.
All right, we'll be right back. Welcome back to this episode of Ask Amy. We're talking with Danny Ratliff of RIA Advisors, and you're giving us a lot of good advice on sort of how we can prepare our finances and things we can do right now, because we hear, oh, you got to be careful. Interest rates are going up. You got to do this, you got to do that. But, we want some good practical tips for people who are sort of monitoring maybe their credit card debt.
Yeah, credit card debt's a big one right now, especially with rates increasing. It's really impacting people's wallets. And unfortunately, it's not just the credit card debt, it's the inflation. So people are spending more. Yeah. We've noticed personal savings rates have declined. Credit card debt and usage has actually gone up, the average balance. So that's not a good sign.
Yeah.
And what we really need to be doing in this environment is paying that credit card debt down. It's tough because people are living paycheck to paycheck.
Right.
It's a difficult environment right now, and I realize that. But if we can eliminate just racking up that debt, because if rates do continue to increase, and I think they're going to have their limits, that's going to become a bigger issue as more people's paychecks going to be required to pay down that debt. And, it's basically, you can pay now or pay later.
Yeah.
And you're going to pay, if you're paying later, you're going to pay that much more because of that interest.
Right. And I mean, so a lot of people were stuck where maybe they were not making minimum payments, they were making more than minimum payments, but not paying off that credit card bill at the end of every month. And then their interest rates went up. I mean, I think now we're looking at above 16%.
Yep, average rates have gone way up. I mean, we're seeing some way over 20. And so depending on what your credit score is. And so obviously this is a time that you should shop. There are still some deals out there. If you had a balance balance and you still have decent credit, you can likely switch. So a lot of times they'll allow you to switch that balance over to somewhere else. They may give you 6 months or a year of no interest. So that's ideal. But the problem is, let's just not make this the snowball bigger and bigger. We want to make sure that you are tackling it. You have a strategy to pay that down, and that's the tough part right now.
Yeah, I mean, and we were just talking. So we did a story on these buy now, pay later plans. I mean, we've had a lot of these businesses pop up just within the last year and a half. That it's like, oh, this is great. Now I can buy that purse I wanted to buy, or those sports tickets I wanted to buy. And you buy now and you pay later, but people aren't thinking, well, what happens if I don't have that third payment when it comes due?
Well, that's right. Or you're buying now and paying later. What's the extra cost? They're not doing it out of the goodness of their hearts.
Right.
They're doing it to make money. And so unfortunately, just like a check cashing place, it's not cheap.
Yeah.
And that adds up very quickly. And so what I find though is that once you get in the habit of doing a little bit of that, it seems that you're just more inclined to do so. Whereas if you have a more of a diligent strategy and you say, hey, I'm not going to go out, I'm not going to live like this, and you seem to do much better with it.
Right.
So create some rules, and I think that create some household rules. If you're married, do so with your spouse. I think that's really important to make sure you're on the same page. Then understand, okay, well, here's our rules for spending. If we're going to spend X amount, we're going to have a discussion about it.
Yeah.
Like we have one in our household is that if we want something over a certain amount of money, we're going to discuss it, and you have to wait a week.
Oh, the waiting a week is big.
Yeah.
Yeah.
I mean, that's huge because most of the time, even if I think I really need something, I find out after a week I don't.
Right. Yeah. You've thought about 5 other things since then.
Yeah,
right.
That's right.
No, I think that's a really good idea. And, buy now, pay later. I could see how when you sort of dip your toe in, because you're already spending money you don't have.
That's right.
And then you have to pay that back. It would get easier to do. And then it becomes, you think, a necessity.
That's right. And, I think that we're all optimistic by nature. So, we're going to get the raise. Things are going to get better. Things will improve. And it just doesn't always happen or happen as quickly as we'd like. So this is where you have to be really cautious.
And so if you had a magic ball, you'd tell us, are they going to get better? I mean, what do you think is going to happen this year? I mean, you're in the business.
Oh, man, this is such a wild year. At the very beginning of the year, all of the economists, portfolio managers, everybody said, listen, first half of the year is going to be terrible. Second half is going to be much better. Recession will be priced in. Interest rates will be priced into the economy. Then we had a really good January and part of February. And really good, meaning that usually what the stock market does in a full year, it did in the first month and a half, 2 months. And then all of a sudden everybody said, whoa, we start to see the market decline some. It said, wait, first half of the year is going to be rough. So nobody really ever knows. So they flip-flopped on this. The same guys that tell us at the very beginning. So there's so many factors at the moment. I mean, we look at all the inflationary pressure that we have. We look at higher interest rates. Higher interest rates typically take a while to really impact the economy. I believe we're going to begin to see that. Inflation has been a lot stickier than what they've anticipated. I mean, you have to remember, this is such a weird and interesting environment in the sense that coming out of the pandemic, jobs have changed.
Right.
We have a demographic where baby boomers are retiring in massive amounts. There's numbers suggesting that 10,000 people are retiring each day.
Oh, wow.
Yeah, I mean, so this is a lot of people that are moving out of the workforce, and so I think employers, one thing that we always watch for is jobs. Jobs are a pretty good leading indicator to give us suggestions on what companies are thinking. What's the overall economy going to look like? And so they'll start to cut back because they're trying to protect themselves. And fortunately, we haven't seen mass layoffs.
Yeah.
Unfortunately, it's not been as good of an indicator. So we're seeing more of blue collar jobs have been a lot stickier. You're not seeing people getting laid off, but it's the white collar jobs. It's the middle management. We're seeing a little bit more of that's coming into fruition. And so as that materializes and changes, I think that's something that we have to keep our eye on.
Right.
Interest rates, if we can't afford the same thing. So we look at retail sales.
Right.
Retail sales have been rather strong, but what we really want to look at is what are the units behind it? How much has actually been sold? People may be spending the same amount of money, but they're not buying as much. I can tell you that for sure.
Spending the same amount of money on far fewer groceries.
Correct. Yeah, it seems like, $100, you get one bag. You're like, what the heck? I can't live off this.
Exactly.
Yeah.
Exactly. So let's talk about the whole interest rate thing, because we started this by talking about how much more your credit card debt could cost you because of higher interest rates. But then we're looking at, say, our money market account or our savings accounts. And when the Federal Reserve has raised interest rates, that doesn't necessarily mean oh, now we're all making more money on all those investments.
It doesn't. So unfortunately, the banks just don't automatically pass that on to you and I and everybody else. So sometimes we have to fight for it and go out and say, okay, move money. And banks are counting on, especially the really big institutions where you feel safe and secure. They've been there forever. They're banking on that we're not going to move funds.
Yeah.
And so what you need to do is look out for your interest. Say, listen, if they're going to charge you more to go get a loan for your credit card, for anything else you're going to do, you need to make sure they're paying you more as well. Unfortunately, that's not always the case. So I would go out and shop. We talked about bankrate.com, NerdWallet, they're aggregators. You can go and search and look up high yield savings. You'd mentioned off air a bit ago that you had an account.
Yes.
That you looked and said, wow, they're paying a great rate, but they're not paying me that. And so I think that happens more often than people realize.
Right.
That you're just in the wrong product.
Yes. So in the same money market account for like 20 years, because that's just where I would move money, to save each month. And then I realized like, wow, this is like below 2%. And it was when some others were paying like, 3 and 4%. So I went on Bankrate, sort of shopped around, found this bank, and had never heard of it before, but I did look at reviews and ignored some of them. And moved my money there. But what I didn't realize is the exact same bank that I had that money market account at had a high yield savings account for that interest rate that I was looking for. And instead of just calling them and saying, move my money over, I was going outside of there. So a lot of checks that you can do.
Yeah, there is. And so I think that you need to make sure that you're looking at the right place. Understand what money's for too, though. So like you want a big institution for your checking, your credit cards, but you may want to look at somewhere else to store funds. So we always encourage people to have an emergency fund, right? That's your basic 6 to 12 months of expenses, depending on what type of job you have. And then my partners and I at work, we've been encouraging people to create a financial vulnerability cushion. So going above and beyond, because what if, emergency funds are great. If your AC goes out, car breaks down, you lose your job. But what if you lose your job and all those things happen?
Yeah.
That could happen. And so we're seeing that people, households are being stressed. And so we want to make sure that, we call it fortifying your balance sheet and your financial security. And so I think that's really important, and make sure that if you have money sitting somewhere, make sure you're getting paid on it.
Yeah, absolutely. Make it work for you.
Yeah, absolutely.
So, okay, we're going to take another quick break. When we come back, I want to talk about that specific funds and places where you could put your money. And then we want to look at some long-term savings, like our 401ks. We always tell people don't look at them because you'll be scared.
Big mistake.
But now we should look at them?
Absolutely.
Okay, we'll talk about that when we come back. Welcome back to this episode of Ask Amy. Danny Ratliff here with RIA Advisors is giving us a ton of great advice on our finances and what we should do. When we ended the last segment, we were talking about interest rates and how you can still shop around, and you want to make sure you're looking for any sort of savings accounts that pay the best interest rate available. One thing that a lot of people don't know about are I-bonds.
Yeah, I-bonds. They became really popular here this last year because they're actually paying really good interest. And so right now, I-bonds are currently paying 6.89%. You do have to be cautious with this because this is where you need an objective for your funds, because you need to understand the time constraints of how long you need to set these aside. So I wouldn't necessarily put emergency funds in something like this, but this could be a really good place to store funds for a couple years, depending on what interest rates do and really what inflation does.
Right.
And so when they pay it on a 6-month increment, but they pay it on an annualized rate of return. So each 6 months they change it. So they'll change that 6.89% after April 27th. So you have some time that you can go out and actually lock in that 6.89 for the next 6 months. Once they change the rate, it'll go down to whatever that rate is for the following 6 months after your time frame is up. So you get a pretty good understanding or idea as far as what you're getting paid. Now, you can't just go to a bank and buy these. You have to go to treasurydirect.gov.
Okay.
And last time, rates were so high before they lowered interest rates again, everybody tried to do it and shut the site down. I mean, people couldn't get in and open accounts.
Right.
So I would advise people to be a little bit, don't procrastinate on this one. Go ahead and get this done sooner rather than later.
Yeah, because you can't go on bankrate.com and find right now a high yield savings that's paying 6.89%.
No, you cannot.
And when you're talking about everybody went and shut the site down, it was like 9 point something, right?
Yeah, it was over 9%. So, and I would envision people doing the same here with this one, just because if they haven't done it already, they forget about it. They want to make sure, because all the publications will be coming out prior to April 27th. And so everybody's going to probably get on the move to try to lock that in again. But, key things, you can only put in $10,000 per person each year, and you do need to keep it in there for at least 1 year. So if you pull it out before 5 years, you forfeit 3 months of interest. So just something to consider if you're going to be making these types of decisions.
And that's exactly why you said you don't want to put your emergency savings in there.
Yeah.
You know, something that you might need in 6 months or 3 months or even a year. I mean, if you want to get the most out of it, you want to be able to leave it in there at least 5 years.
Correct. No, well, yeah, I mean, ideally, but you may, in a couple years, interest rates may be way down again, and it just may not be beneficial to keep it there. You may be better off taking it out and doing something else with it.
Okay. All right. And I will say, I was able to go in. I mean, anybody can go into treasurydirect.gov. We'll put all of the links for you in our show notes on how you can do that and sign up. We did a story on it just to explain to people how that works. And so a lot of people were like, oh, fantastic. Oh, but I can only put in 10 grand.
Yeah.
But you said there is a way to put in more.
There is. So you could do what they call a gift box. So it allows you to go in and you could gift somebody $10,000. So for married couples, we see this happen quite a bit where they'll do $10,000 for each of themselves and they'll do what they call a gift box. And you can just check it. The website's actually, for a government site, pretty good.
Yeah.
And it's a lot easier to set up an account and create it than it used to be. So you go create the account, you set it up like you're going to invest it, you click the drop down for I-bonds, and then you just click the box that says it's a gift. Now, the caveat is you can't give them, or you can only gift them $10,000 per year, and then you have to take it out in specific years where they're not taking other funds out. So there's some other requirements you'll want to look on the website, but it writes it down and spells it out pretty easily. So just another way to put a little bit of additional funds aside.
Yeah, exactly. So, for example, if you're married and you each put in your own $10,000 and then you gift your wife $10,000, she gifts you $10,000, then all of a sudden you guys have been able to invest $40,000.
Yeah.
That sounds a lot better.
Heck yeah.
Than 10. Okay. All right. So the other thing we want to talk about is I think I have, heard forever and also sort of lived by the whole motto of you put your money in your 401k, you just have it taken out of your check and you set it and forget it.
Yeah.
And you don't look at it. Yeah, you're saying that's not what we should do right now.
That's a tough one because many people are just prone to either one, they don't want to check it, right? I mean, they're stressed right now because they're seeing that the markets were down. S&P 500 was down 18% last year. The NASDAQ was down 32%. Fidelity came out with a study, said the average investor in a 401k was down 23% last year. Yeah. That's a lot of money.
Yeah.
So if you had $100,000, you had, less than 80. If you had $1 million, I mean, think about this. We're talking, these numbers are rather large. And so that was a bad year by all accounts. As we talked earlier, even bonds were down significantly. They were down on average 13%, the bond index. So really bad years, no real place to hide. And so I think what people need to be cautious of is understand what you are invested in. One thing we do see a lot is age-based or target date funds. So meaning that they're supposed to get more conservative the closer you are to retirement. I would pull that fund fact sheet up, take a look, see exactly how conservative you are, because many times people think that, oh, yeah, I'm in a 2020 fund. So that was 2-3 years ago.
Yeah.
Should be super conservative. Many times it's not nearly as conservative as we think. So we want to be really just have a very good understanding as far as what you're invested in, what type of risk are you taking in this type of environment. What if the market goes down more? You asked the question that everybody asks, are we going into a recession? Yeah. We may be in one right now. We just won't find out till later. They may come back and say, hey, we've been in a recession, but the market may be looking forward and say, hey, but the light's at the end of the tunnel. We're moving out. We're moving past this. So this is where, if something, we don't have that black swan event. Silicon Valley Bank was the second largest bank ever to go in receivership. Big deal.
Yeah.
There could be more shoes to drop in the future. Other banks, other big institutions that have what we would call systemic risk, or the kind of the contagion factor, where everybody, they have a problem, the next company has a problem, then the next company. And so that's what we have to watch for. But when it comes to 401ks, I would certainly take a look. Don't be afraid of using stable value, putting some funds, parking it in cash for a while. Understand your risk tolerance. We don't want to make knee-jerk reactions. And the old saying is that you want to make sure and take advantage and buy low and sell high.
Right.
So if you're still contributing, and depending on how far you have to retirement, I think is a really big deal. If you got a long ways to retirement, we may want to get a little bit more conservative as far as what your overall allocation is now. But your current contributions, we may still want to be rather aggressive and go buy some of these asset classes that are down if we think that we're going to see them come up in the future.
All right, and what you mean by that, and we'll put more on this on show notes, is that when you go in, if you go in electronically and look at your website and look at your 401k, is you may have a whole lot of money stacked up in one particular fund. Is that fund aggressive, where, it could be pretty volatile and go down, you could take that money and move it to something within your 401k that is more conservative.
Correct. Yeah. And so the way I always look at this is that if you can be diligent and watch this, you want to be able to utilize these funds for protect them right now. And we don't know. Nobody knows exactly what the market's doing. If I did, I'd be on the beach with a coconut drink in my hand. But we do know that, while markets are as volatile as they are right now, having some cash on the sidelines may give you a little bit of, sense of calmness or give you peace of mind. And I think that's not a bad thing. So we want to make sure that you're protecting yourself. But then you can go shopping. If there's a big sale, everybody likes sales.
Right.
Macy's has a Red Apple Day sale. Right. I mean, everybody wants to go. So same thing with the markets on sale. We want to be able to buy. So with those new contributions, we're putting back into it. But then we have the ability to go out and use that cash to go buy things at better prices.
Got it. That makes perfect sense. Thank you so much for coming on and talking with us today.
Yeah, thanks for having me.
Thank you. And our show notes will also link you to how you can get in touch with Danny Ratliff and RIA Advisors. Everybody go out and heed his advice and have a great day.